Consumer Price Index, the Fed's favorite reading on inflation. That's our topic for this morning's Backstage Pass. Good morning, I'm James Lopez, president at HomeFi Corporation. So we expected today the CPI data to be a market-moving event, and it did not let down. CPI data came in much hotter than what was expected, and so the bond market is moving in an unfriendly direction. Mortgage bonds are down about 45 basis points at the time of recording. The 10-year yield is up about 6 basis points. And so what that means for mortgage interest rates this morning is that interest rates are going to open up higher this morning than where they left off yesterday. Now, in digging into the data for the month of May, month over month, the core CPI reading was at 0.6%. The core CPI reading year over year for May was at 6%. And then the full CPI reading year over year for the month of May was at 8.6%. All of those were higher than what was forecasted. Now, the CPI is what's known as the Consumer Price Index. And I'm going to read this definition to you and throw a graphic up on the screen so you can kind of see all the stuff that's built into the CPI, all right? So the CPI is a measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. Now, core CPI is the change in prices of goods and services except for those from the food and energy sectors. That's because food and energy have very volatile prices. Now, CPI data is prepared by the Bureau of Labor Statistics, and it's used by economists and the Fed to measure inflation. So why is the bond market reacting this way, and what does that have to do with mortgage and housing and real estate? Now, remember, inflation is the enemy of the bond. A bond is a fixed rate of return, longer term investment typically, and so as inflation goes up, the actual realized return goes down. So whenever, investors see the inflation numbers going up, they buy less bonds. They stop buying bonds. Now, specifically in mortgage-backed securities, which is what we watch for the mortgage market, as the demand for the bond mortgage-backed securities goes down, the price starts to go down. So in order to create more demand for mortgage-backed securities, we raise interest rates, all right? Because the return on the MBS, the mortgage-backed security, is actually based on the underlying notes inside that MBS, which is the mortgages, which is whatever the interest rate is for that mortgage or the group of mortgages. So we raise interest rates, creates more demand, and keeps liquidity in the U.S. housing market, and that's the engine that keeps the U.S. housing market going. Now, here's the good news in all of this, right? We always try to find the silver lining, look for the good news. The Fed is taking steps to fight inflation by doing things like raising the Fed fund rate and things like that. Okay, so eventually mortgage interest rates will come down. When? We can't say. They will moderate, they will come down. We're not sure when. But here's the deal. If you're waiting because interest rates are high right now, or if you're waiting because home values are high right now, let's say last year you waited, housing market's crazy, I'm going to wait until next year to buy. You missed out on 20% appreciation. That's massive. If you wait another year, we just talked about CoreLogic's, their forecast for appreciation for next year by this time is 5%. If you wait another year, you're going to miss out on appreciation. If interest rates are bothering you, interest rates will come down. And so go ahead and make that purchase, buy that house now, and then the future, at some point in the future, a year or 2 years, refinance into a lower interest rate like millions of Americans did last year. You lower your monthly payment. Maybe because of appreciation, you can get out of PMI as well if you're paying PMI. So what I'm saying is that, look, housing is difficult across the board right now. It's hard to find a place to rent. It's hard to find a place to buy. Rents are up. Prices are up. Interest rates are up. So whenever you buy a home, you purchase a home, you immediately start to build wealth. You get the benefit of appreciation. You get the benefit of amortization. And most importantly, you get the benefit of owning your own home. All right, now listen, that's all the news that we have for today. I hope you have a wonderful weekend. Remember, stay positive, and we will see you on Monday.